Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Suncor stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Suncor's specialty is the production of synthetic crude from oil sands, which is just one of many ways to extract oil. The sand is removed from the ground and put into trucks, which then bring it to crushers where the large clumps of earth are processed. Once the oil sand is crushed, hot water is added so it can be pumped to the extraction plant. The company also generates revenue from refining and marketing, as well as exploration and production. It was selling retail gasoline as Sunoco in 480 locations until it acquired Petro Canada in 2009, and it changed all of its Sunoco gas stations to Petro Canada. Sunoco branded gas stations can be found all over the US, but those are owned by Energy Transfer. Suncor is a fully integrated oil company that pulls the oil from the ground, which is the very first step of the process. This is the upstream part. They then sell the oil directly to the retailer, which is the last step of the process. That is the downstream part. Its renewable energy division includes interest in 4 wind farm operations in Ontario and Western Canada. Also, the 40-mile wind power project, which was restarted in early 2021 and is currently planned for completion in late 2022, after the project was paused temporarily. Last year, the company increased its investments in clean technology, including LanzaJet Inc., a company working to bring sustainable aviation fuel and renewable diesel to the commercial market, and also the Varennes Carbon Recycling Facility, a biofuel plant in Varennes, Quebec, that is designed to convert commercial and industrial non-recyclable waste into biofuels and renewable chemicals. This company is also one of the largest Canadian retailers of petroleum products. Its headquarters are in Calgary, Alberta, Canada, and it was founded in 1919. The province of Alberta is one of the largest producers of oil on the entire planet, and this company is a big part of that. It trades on the TSX, New York Stock Exchange, Mexican Bolsa, Deutsche Börse, and Swiss Stock Exchange. Let's get started with the model. This is a large cap company, 48 billion market cap. They're trading at $33 a share, and they have 1.5 billion shares outstanding. We're looking at the ticker of the trades on the TSX, so all the numbers in this video are in Canadian dollars. The company also trades in the US. It's the same ticker, SU. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow every year except 2020. Oil prices were really low in 2020, so their revenue declined and they lost money. But their free cash flow really rebounded in the trailing 12 months. It's higher than 2019 or 2018. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also positive each year except 2020. Revenue is the sales for the company, and that was strong in 18 and 19, dropped a lot in 2020, but it rebounded quite a bit in the trailing 12 months, almost 35 billion Canadian dollars. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their 19 and 20 revenue by country. Canada is the bulk of their sales, 21 billion in 2020. US is second at 3.3 billion. And then 762 million in other countries. They have operations in Norway and the UK, so that must be the other countries. Here's a breakdown of their 19 and 20 revenue by product. So in 2020, 10.5 billion from oil sands, 17 billion in 2019. They sold a similar amount of product in 2019 and 20. It's just the price of oil declined so much, that's why their revenue declined. And their oil sands revenue is made up of their Athabasca oil sands in Alberta. Also, 2 joint ventures. One of them is the Syncrude oil sands, and the other is the Fort Hills partnership. Exploration and production went from 3.1 billion down to 1.8 billion. This includes offshore activity in East Coast Canada. They have interest in Hibernia, Terra Nova, White Rose, and Hebron oil fields. Also, they're set up in the UK and also in Norway. And this division also includes marketing and risk management. Their largest division is refining and marketing. That went from 22 billion down to 15 billion. When you pull oil from the ground, it cannot be used until that oil is refined. So the company transforms the oil so the end user, the retailer or wholesaler, can use it. So this includes all their sales to their retail and wholesale networks in Canada and the US. This also includes trading of oil, gas, and power. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That dropped a lot in 2020, but it has come up in the trailing 12 months. It was highest in 2018 at 19 billion. Below that is their operating expenses and then their operating income. And it was negative in 2020, but they actually have positive operating cash flow because a company like this passes through a lot of depreciation expenses, which are non-cash items that bring down your operating income but don't affect cash flow. I'll show you later on a cash flow from operations section. They paid 1.3 billion of interest on their debt, and the bottom line of the income statement is their net income, which is negative in 2020, positive in the other years. Let's look at a breakdown of their 2020 income statement so we can look at what all the expenses represent. 9.1 billion is the purchase of crude oil and products. Then they have about 10 billion in SG&A, selling, general, and administrative costs. This is payroll, marketing, insurance, just the everyday cost to run the facilities. Transportation is big, 1.4 billion. They need to transport the products. 9.5 billion of depreciation, depletion, or amortization. This is a non-cash item, so this is why they have positive cash flow but negative net income. They received a tax credit of 659 million of cash and a deferred tax credit of 1.1 billion. So they have to carry a deferred tax asset on their balance sheet of 1.1 billion dollars, and they'll receive that cash in the future. So we have to reverse this out on the statement of cash flows. The way a deferred tax asset comes about is a difference between the way a company calculates their taxes and the way the government calculates the taxes. The current taxes is the way the government calculates it, so that's what the company actually receives. And the deferred taxes is what the company calculates, so that's why they have to carry it onto the balance sheet. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So even though they had a net loss in 2020, they actually generated 2.7 billion of cash flow. They don't have the trailing 12-month number because Yahoo Finance didn't pull in their 9/30 cash flow numbers. I just manually calculated that number in my Excel model. So in 2018 and 19, they generated lots of cash flow. It did come down a lot in 2020 because oil prices came down a lot. And they spent a good amount of money in CapEx each year, $4 to $5.5 billion. Operating cash flow minus CapEx gives you your free cash flow. And that was negative in 2020, positive in the other years. So it looks like they're buying back a lot of stock. They bought back $3 billion in 2018, $2.3 billion in 2019, and $300 million in 2020. When a company buys back stock, that decreases the shares outstanding and makes your shares more valuable. They also pay a nice dividend, so the company seems pretty generous. That's the two ways to reward shareholders: pay a dividend or buy back stock. And you can see they didn't issue any debt in 2020, but I'll show you in a statement of cash flows they actually issued debt. It looks like Yahoo Finance didn't bring in this number. They did pay down 335 million of debt in 2020. That is correct. In the company's third quarter presentation, they mentioned their cash yield is 9%. They pay a 5% dividend and they buy back 4% of the stock. So that's how they give 9% to the shareholders. This is the company's 2020 cash flow from operations section on the statement of cash flows. They generated $2.7 billion of cash flow. The way you calculate that, you start with their net loss of $4.3 billion. Then you have to add or subtract the non-cash items on the income statement. We have to add back the depreciation of $9.5 billion. We have to minus out the deferred income tax. That was a credit on the income statement, but since it was a non-cash item, we have to minus that out on the statement of cash flows. You also have to adjust for changes in working capital. That was negative 1.2 billion. So even though they reported a loss, they actually generated positive cash flow. This is the company's statement of cash flows in the third quarter of 2021. So their cash flow from operations was 4.7 billion. Their capex is 1.2 billion. So their free cash flow just in the third quarter was 3.5 billion. Their free cash flow in all of 2018 was $5.1 billion, and 2019 was $4.9 billion. In the trailing 12 months, it was $5.6 billion, which includes this $3.5 billion. That just shows you how well they did in the third quarter. That's because oil prices were through the roof. And the company doubled its dividend in the third quarter. I'll show you later. This is the rest of the company's statement of cash flows from 2020. The top part is the investing cash flow section, and that starts with CapEx of $3.9 billion. And they had $557 million in changes in working capital. I've never seen changes in working capital in the cash flow from investing section. I've only seen it in the cash flow from operations section. But I can't really get the detail on what this $557 million is. Let me know in the comments if you know what this is, or if you've ever seen changes in working capital and cash flow from investing. And the bottom part is the cash flow from financing section. You can see they repaid $335 million of debt. They added $4 billion of debt in 2020. That wasn't in Yahoo Finance. It's fine to use websites like Yahoo Finance to get information, but you should also reference the company's financials, just in case those websites are missing info or the info is incorrect. They repurchased $300 million of stock in 2020, and they paid out $1.7 billion of dividends. Let's look at the capital structure. They have $36 billion of equity, $19 billion of debt. They're 66% equity, 34% debt. And I gave them a WACC of 9.3%. That's the middle WACC on Finbox. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $61 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $55 billion. We divide that by 1.5 billion shares. And we get a calculated stock price of $38. They're trading at $33, so they're trading at a 14% discount. It's a buy according to the model. The average analyst projects their revenue to grow 2.5%. I grew their revenue 2.5% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I needed to see what percent of their revenue they converted to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers, and that's 10.6%. So I multiplied their future revenue estimates by 10.6%. That's how I got their future free cash flows. And it does seem reasonable, even if they hit these numbers, which are lower than 2018, 19, and the trailing 12 months, the stock is still undervalued. So it seems like there's lots of upside potential for this stock. Simply Wall Street is way higher than me. They're at $89 a share. They're saying the stock is 63% undervalued. 10 analysts priced the American stock, which is trading at $26.25, and the average price target was $31. The low was $22.50, the high was $43. Here's the stock price since 2017. So you can see it was up and down, but fairly steady for a few years. Remember when oil futures became negative? All oil stocks crashed, as this did. You can see all this selling activity, and the stock came way down. It has come up since the bottom, but it hasn't come up that much. It's still trading well below its pre-crash highs. This stock is fairly correlated to the price of oil. This is the price of oil since 2017, and it looks very similar, right? You can see the price of oil dropped right here, the same time the stock dropped. And then it was up and down, but pretty steady for a few months. Same thing with the price of oil. Then it crashed. Same thing with the stock price. But you notice one big difference. The price of oil came way back up, past to where it was the past few years. But the stock price hasn't come up nearly as much. It's still trading well below what it was a few years ago. So this stock may have major potential to hit $50, $60, $70 a share. It should be tracking oil pretty closely. But at this point, it's not. It still seems to be lagging oil. It's really interesting because the stock price was so similar to oil for so many years, but just at this point, it wasn't. Maybe the reason the stock price isn't coming up because investors feel oil demand will be low in the future, but there's no signs of that happening. Every year, OPEC forecasts the future demand of oil. The blue line is the forecast in 2019. The orange is the forecast in 2020, and the gray is the forecast this year. In all the scenarios, oil is expected to increase. The demand for oil has increased pretty much every single year in history, except in 2019 to 2020. That was a little different. People were stuck in their home, not many people driving to work, hardly anybody was traveling, so oil really dropped a lot. But some critics of oil say renewable energy is going to take over oil. That may happen, but it will be a long time until that happens. It's going to be a really slow progression. And this is a really volatile stock. It has a beta of 2.03, so it moves 2 times the market. It's gone up 71% in the past 52 weeks, while the S&P is up 32%. The 52-week low was 18, the high was 33, and the stock is trading above its 50-day and 200-day moving average. This is a pretty popular stock. Over 9 million shares have been traded each day on average. All the shares are on float, 73% are held by institutions, and under 2% of the shares are shorted. The third quarter of this year was one of the company's best quarters ever, so they increased their dividend 100%, from 21 cents a share way up to 42 cents. Their dividend yield is over 5%. That's a really generous dividend, which is 102% of their net income, 44% of their free cash flow. The dividend comes out of the free cash flow, so it's a better indicator to look at dividend over free cash flow than dividend over net income. Because as you know, the company has a lot of depreciation that brings down their net income. Their industry pays a 4.3% dividend, so they're higher than their industry, but analysts are projecting them to decrease their dividend back down to 4.3%. Their employee count has been decreasing from 14,000 back in 2015 to 12,600 currently. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $11,300 today. That's not such a great return on investment. So when you invest in a commodity like oil, it's really about timing it right. If you would have invested just a year ago, you would have more than doubled your money. But if you invested 10 years ago, you would have been pretty much flat. A really good sign is pretty much all the insiders are buying the stock. There's pretty much no selling. Lots of buying by lots of different people. So it seems like the insiders are pretty bullish on this stock. Dodge & Cox is the biggest shareholder at 4%, then Fidelity, Vanguard, Fidelity International, and RBC. Let's look at their financial ratios. Their PE is pretty good at 19.9. That's better than the market median and average. PE is stock price over earnings per share. A really good price to sales of 1.4 and a good price to book of 1.3. Their return on invested capital is a little low at 5.6%. I prefer to see at least 10%. They could cover the interest on their debt 3 times. Their ROE is 6.6%. Their current ratio is 1, but their quick ratio is 0.6. They have $2.3 billion of cash on their balance sheet, $4.3 billion of receivables, and $4 billion of inventory. So the company does seem to be in good shape financially. They generated $5.6 billion of free cash flow in the trailing 12 months. They do have negative working capital, but it's a small negative, and they pay $2.5 billion out in dividend payments, so they have $3 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 10 companies in the same industry as Suncor, and if Suncor has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're much better than average in price to earnings, a little worse in price to sales, they're average in price to book. They do have one of the worst current ratios, but it's at 1, so it's fine. Plus they're bringing in lots of cash flow, so it's not too much of a concern. Their ROE is a little above average, they're average in debt, and when I convert all the market caps to Canadian dollars, they're a pretty big company, close to 50 billion Canadian dollars, but the average is much bigger than them. Everybody in this industry pays a dividend, but their dividend is a little higher than average. So to summarize, I have them trading at a 14% discount, but I was really conservative with my model, so I think there's a lot more upside. As we looked at earlier with the price of oil compared to the company's stock price, it seems like there's a lot of upside potential with minimal downside potential. Of course, if the price of oil crashes, then the stock will go down. But the stock price has been increasing, but a much slower pace than the price of oil. And oil is definitely not going away. There's so much money and infrastructure and resources that we put in to creating the products that use oil. And those can be replaced, but it's going to take a really, really long time for that to happen. Plus, so many people work at these companies that develop oil. Especially at developing countries, They're much further behind developed countries like us in Canada. So they're much more reliant on oil than renewable energy. So if you watch my videos, you know I'm really bullish on oil. So I'm definitely bullish on this company. I think it's a great long-term hold. I rank their free cash flows and revenue 8 out of 10 and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.